Well, Neil, you're always active when it comes to the financial markets and a lot of the crypto markets as well. But how are you when it comes to mutual funds?
Well, I mean, mutual funds, the introduction of mutual funds to me was through ads that came on television which said mutual funds are subject to market risk. Please read the offer document carefully before investing. And I was like, okay, I like these guys because they're upfront and telling you, listen, they are subject to risk because eventually they are. I mean, any money that you're putting in the stock market, you are subject to market risks. But these guys are telling you.
Yeah, well, there's full disclosure. You've actually got less risk on that investment.
I mean, the risk is always there.
Well, the risk is always there, but the buyer or the purchaser, is I think it's safer if someone's declaring the pros and cons.
Yeah, you at least then, are aware that, okay, there are cons. There are not just pros. There are not just 14% returns and 15% returns every year. There could be a bad fix, and you might just lose some money. So at least you'll be aware of the market situation.
Well, no actively managed stock or bond funds outperform the market convincingly and regularly over the last 5 years. In fact, index funds have generally been better. It's actually very hard to beat the stock or bond market with any regularity. Well, to get more details on this, Sandeep Jadwani is the Head of Investment Advisory from Habib Investment, and he joins us once again. Thanks again for your time, Sandeep.
Hey, Kech. Hi, how are you doing, Neil? How are you doing? Thank you so much
well.
for having me on the show.
So thank you so much, Sandeep, for joining in. Conversations obviously keep happening when we talk about mutual funds. We talk about how they've been performing, how the market has been performing. But, I like Kitch's question here that, when he asked me about mutual funds, I said my introduction happened when, I read when the statement came to me that mutual funds are subject to market risk. Read the offer documents carefully before investing. What does that mean, though?
So, because none of these mutual funds or index funds are guaranteed by any bank like a fixed deposit.
Right.
And hence, investing in any of these funds, whether equity or bonds, are subject to market risk. Example of a market risk is the 2020 that we have experienced, and it's very fresh in our market, in our minds, where the bonds and stocks both went down by almost 30-35% together. And if you needed money during that time, you would be losing about 35% from the highs. Okay. And it's important to know that since it's not a fixed deposit, you will lose capital.
Right. So now there's something else that people talk about when they talk about mutual funds, and that is ETF. Right? What is ETF and how different is it from a mutual fund?
So mutual funds and ETFs, mutual funds were the first. Let me give you a definition first, okay?
Perfect. That'd be great.
Mutual fund? Mutual fund is a fund of pooled money of investors who have a same objective of investing. Example. There's a person, let's call him the fund manager. He says, I'm going to invest only in selected large cap companies of, let's say, US, which includes your Apple, Microsoft, and other things. And buying and selling is on him. So if you and I have the same objective to invest, we would say we would give the money to the fund manager. He'll do the buying and selling.
Right.
And over there we have Kech, who says, hey, you know what? I don't want to go with the large caps. I want to go with the whole of market. And I don't want to pay the fund manager any money, okay, because I feel markets are efficient, and eventually efficient markets tend to outperform. So he goes with the index fund where he buys, let's say, S&P 500, and he buys the entire S&P 500 with even $100. Okay. In the same proportion, pro rata basis. Okay. ETFs or index funds usually perform better in a one-sided market, upside.
Upside, okay.
Okay, so the global markets have seen the longest bull run since 2010. So 10-year bull run until 2020, where if you would have entered into a passive, a non-actively managed fund, you would have made more money purely because of lower charges.
Right.
At the same time, from 2020 until today, actively managed funds have performed better.
Okay. Right.
Okay, because the human element comes into play, and
Makes sense.
We can foresee, the fund manager can foresee that though they've lost money, but they've lost less money.
So when you look at the obviously, when you want to look at the future and the risk towards the future, is this outperformance still going to exist?
The outperformance will always exist because of inefficiencies,
Right.
okay, and human bias. However, in a rising market, it's always good to stay passive. And once we know in a recessionary market like we are in today, it is good to be with active managers or active mutual funds that will perform much better.
Interesting. Now, see, this is where one tries to understand that many a times you want to trust someone who has probably the experience, but you sometimes feel that, oh no, I've been watching the market myself. My abilities to read the markets are better, and I want to do it on myself as compared to relying on a fund manager, because when I tried to do with a smaller amount in the last 1 year, I probably got more returns as compared to, say, a Kitch, who went to the fund manager. How do you break that bias?
So, a solid question. I've been in this field for over 1.5 decades, and this was a statement that came to me the whole of 2021. Okay, where my performance as an active manager was 23 and 24% per year, which is not bad.
Not bad at all.
But I was a severe underperformer because clients doing on their own almost got 40% returns. Because
wow.
whatever they touched turned to gold.
Okay.
Come 2022, they are down 30%, and I'm up 13.5%.
Wow.
Fantastic.
So is that more the point that, if we look at some of these actively managed funds that did better than the market overall over the last 20 years, you've still got to maintain that they didn't do it consistently year after year. They had a couple of good years, then a bad year, then another couple of good years.
Absolutely. However, and hence the thing comes in that absolutely no one, not even me, not even the biggest economist in the world can predict which fund manager could do exceptionally well versus a benchmark.
Right.
And hence the benchmark becomes the passive non-active managers, and a portfolio should consist of both active and passive.
Right.
So almost 50% should be passive, and 50% should be further split into smaller thematics, directional investments. And this is for a person who's more on balance aggressive position on his risk appetite.
But then is this applicable for, say, a small time investor who's probably investing, say, maybe hypothetically, say 1,000 dirhams a month? Is this applicable for them as well, or is it only applicable for the giant investors?
No. So everything is applicable to the time horizon.
Okay.
So if you only have a 2-year time horizon, whether you are 1,000 dirham per month investor or a 1,000 million per month investor, if you don't have the time horizon on your side, both of them will fall on their face equally.
Okay. So how do you define the time horizon for, and what works well?
So bare minimum for a passive investment, you need a 10-year time horizon.
Okay.
That you consistently put aside 1,000, let's say, okay, in a very, very boring basis, which is the best thing.
Right.
On the other hand, you say, hey, you know what? I have a 5-year time horizon and I'm slightly aggressive. I will go with active managers who do their due diligence, pick out opportunities in the market, and in these 5 years, out of the 10 investments that I'll make, 40 will tank, dramatically. 20% will not make any money, but the balance 30% will actually make 4x of my money, and overall the portfolio will perform better. You can't pick and choose though over here which particular one will be good. You need to be spread across. Never put all your eggs in one basket, they say, right? So even in strategy, you need to be active and passive together. You can't stick to one strategy throughout.
Makes sense. This is interesting. The way you explain, I'm sure that our listeners also get to understand this complex, because it's not a very simple, subject to understand. People have, and especially when people burn their fingers by investing in stocks, they tend to be, a little, difficult to willing to try and put money again. Like my dad, he went early in the market, thinking that it's a great thing to do and whatever. Lost sizable amount of money only because he went by the advices of people whose advice he shouldn't have heard. Okay, lost some money, and after that he came out of the market saying, listen, this is not where I'm going to invest. He hasn't invested a penny. Hasn't invested a penny since that loss of his.
I will say one thing, that in a flattish market, active investment strategy does very well.
Mm-hmm.
Okay, and it's always important to be in the market.
Okay.
However, one thing's for sure, that you need to invest in line with your risk appetite and time horizon.
Right.
That's the bottom line for anything. And compared to India versus US, let me take these two examples.
Mm-hmm.
Okay, a couple of years back, there was no access to Indians staying in India to invest in ETFs or index funds.
Right.
Okay, so the best thing was the best fund manager.
Mm-hmm.
So if you compare India active managers versus India ETFs or passive index investments, they've not done good, because India was not very efficient in their reporting compared to the US. So the US markets are very efficient.
Mm-hmm.
And when the markets are very efficient, it becomes very difficult to consistently beat that market.
Right.
Well, to get details about mutual funds, we've been speaking to Sandeep Jadwani, who is the Head of Investment Advisory at Habib Investment. Sandeep, we appreciate your time as always on TSB.
Thank you so much. Thank you so much, guys. Please enjoy. Stay invested.
Yeah, thank you very much. You know, and I think that, isn't it true? You know, Sandeep goes through, even when we're talking about whether you're just buying shares or whether it's gold, whether it's managed funds, you know, the old idea of do your own research, you know, and only, you know, and using your head and not your heart when it comes to your investments.
No, very, very true, Kitch. And one thing that, you know, I've learned, be willing to lose all the money that you're investing. If you have that kind of
only
risk,
invest what you can afford to lose.
Absolutely. I mean, you know, I've put in money in crypto, and the world knows it because we keep talking about it. And it fell down from 60 to what it is, 1724. But at that point, you know, where, and this was an advice that was given to me by a very, very close friend of mine. He was like, Neil, we don't know nothing about crypto market. Keep booking your profits. So whenever, you know, so if I would say enter at 50,000, when I entered at 50,000, and when the price went to say 52,000, I would take that 2,000, you know, the amount
your initial investment, yes.
So I kept removing my profits and kept the base always there. So what has happened is it has helped me, you know, in some way absorb the shock of the sudden drop in prices. I've made my profits. I made my money. I know someone who's lost a lot of money because she never wanted to move out of that zone.
Well, you know, you always got to diversify. You know, those key rules are always true. TSB talks more business on Talk.